안녕하세요. 한경글로벌마켓의 김현석 뉴욕 특파원입니다. 뉴욕증시의 S&P 500 지수가 5,500에 달해 있습니다. 높은 밸류에이션이 이제 문제가 되는데요. 그런 차원에서 이머징 마켓 주식으로 다각화를 해야 하는 거 아니냐라는 얘기들이 월가에서 나오고 있습니다. 하반기에는 아무래도 미국 중앙은행 페드가 금리를 내릴 것이고 글로벌 경기가 살아나면 이머징 마켓 주식들도 오를 것이다. 이런 예상들이 조금 있습니다. 이머징 마켓에는 이제 중국 시장이 큰 비중을 차지하는데요. Bca리서치에서 중국 시장과 그리고 이머징 마켓을 담당하는 아서 부닥의한 전략가를 모시고 중국 시장 그리고 이머징 마켓 시장에 대한 투자 전망에 대해서 들어보겠습니다. Could you please introduce yourself to our audience briefly?
Hi, I'm Arthur Budagyan, Chief Emerging Market China Strategist at Bcaresearch. Bcaresearch is an independent investment research company that has been around for 75 years. We'll look at the global macro picture and make investment recommendations to investors around the world.
First questions. The Chinese market has been recovering since the beginning of this year, but has been faltering again since last May. Has the momentum been lost? What is your assessment of the current status of Chinese market?
Yes, I think Chinese market has lost momentum. Outlook for next several months is down. I think Chinese stock prices will keep falling again because economy is not recovering. Economy is struggling, is not recovering. Corporate profits are going to be weak, disappointing. Why? Because not only growth is weak, but also prices are falling. China is experiencing deflation and falling prices affecting corporate profit margins and profits.
The problem is in the Chinese real estate market still?
Yes, I think the Chinese real estate market, it's epicenter of a problem, but I think problem is not limited to that. China has been investing a lot and it has created many companies and entities that have a negative cash flow. So companies are having negative cash flow. They keep borrowing from banks, trying to cover the negative cash flow, but they're not investing this money, so it's not creating growth. So epicenter of a problem, yes, it's a property market, but problem of credit excesses and overinvestment and misallocation capital goes beyond Chinese real estate market.
What are the solutions to solve their problems?
China can use two types of solution. Short-term solution, let's say China can do major easing, stimulus, monetary easing, and fiscal easing. China has capacity to do that because China has central bank and China can borrow a lot of money, central government, and reflate, stimulate economy. However, China was doing it for past 15 years, and all this stimulus of past 15 years created even more misallocation of capital, more negative cash flow projects. So doing that type of stimulus will improve economy for next 1.5 years, 2 years, but then we are going to face the same problem, probably even on a larger scale. Second solution, which is going to be much slower working, is that we won't see benefit of it imminently, but is going to create much healthier Chinese economy in long run, is to go through all these negative cash flow companies and try to restructure them, to improve efficiency of these companies. Companies are no longer negative cash flow companies. They become much more reasonable entities. In that case, all the credit the Chinese credit system creates will not go to these negative cash flow companies. It will go into new investment. That's a kind of much slow, much healthier story for China.
But do you think their government will gonna choose that kind of restructuring?
In fact, I think many investors have been surprised in the past 12 months that the Chinese government is not stimulating aggressively. And I think the Chinese government realized that problem in economy has been created because of those past previous stimulus. So doing another stimulus, yes, it will solve problem in a short run, but is not going to solve problem in a long run. So I think Chinese government understands the problem and they're trying to apply kind of a slow moving, but eventually kind of the framework, the type of restructurings that will lead to healthier Chinese economy. But it also means that in a short and medium term, it still will be very painful. So Chinese authorities seems to be resorting to short-term pain, long-term gain scenario. So far, it seems to be intact.
I guess if they choose that kind of restructuring, that will weaken the political status of C. That's the problem, I think.
It's a valid concern. And if economy collapse and Chinese economy experience major kind of a acute crisis like US had in 2008, yes, that will undermine kind of political stability in China. But if these reforms are done gradually, not in a kind of acute way, more gradually, pain will be spread over the time, and it won't be acute problem of rising unemployment that is going to create political volatility, instability. So I think that's what government trying to achieve, not to do these reforms in very acute, in short-term period, but extend those restructuring efforts over many years. So pain is spread over many years and political system and stability remains there. So I think that's what government trying to achieve. It remains to be seen. It's possible, but clearly what's relevant for investors to understand the Chinese government is not ready to provide another big stimulus. So don't bet on a quick recovery in Chinese economy. That's a takeaway from my analysis for investors.
And how might the potential re-election of Donald Trump impact the broader Chinese market and economy?
I think initially Donald Trump, if elected, will be threatening not only China, but also many other countries, including Japan and Korea and Europe and Mexico, with very high tariffs. That will be kind of how he is going to start his presidency. However, I think ultimate goal of Trump 2.0 presidency will be to devalue dollar. So tariffs will be kind of a threat to force other countries to devalue their currencies. The key question, will China be willing to appreciate its currency? We know when economy is struggling with deflation, weaker growth, appreciating currency is the wrong policy. But I think Trump administration will be putting pressure on China to revalue its currency. And it remains to be seen what kind of agreement Chinese leadership and Trump administration reach if Trump is elected. Again, short term, it will be threat over tariffs, but ultimate goal of Trump administration will be not introducing very high tariffs. The ultimate goal will be to revalue other currencies and devalue US dollar.
Okay. How do the geopolitical tensions, especially the US-China conflict, influence your investment strategies for broader emerging market?
Trump is going to introduce more geopolitical uncertainty with a relation in China in terms of using tariffs and forcing China and other countries to revalue their currencies. And there could be high probability that Trump administration will succeed devaluing dollar. If dollar is devalued, that's a bullish positive news for emerging markets, because when dollar goes down, emerging market assets typically do well. Stocks, local currency bonds, of course, currencies. So I think initial shock will be negative, but over the next few years after Trump presidency, the global macro environment will be beneficial for emerging market risk assets.
That means it's not the time to invest EM, just focus on the American market?
For now, I think a dollar will go up for next 6 months. The dollar goes up, emerging market risk assets will sell off and underperform. But again, beginning next year, that could be turning point in emerging market underperformance, and it could be time to rotate out of US into EM, because in a common currency terms, as dollar is devalued, emerging markets might start outperforming. But again, we'll be monitoring And if needed, we'll change our call, our recommendation. But for now, our recommendation has been and remain underweight emerging market and remain bullish on US dollar.
Do we need to invest EM except China in that case?
I think EM ex China will do better because when EM currencies go up, it's much more important for EM ex China market rather than for Chinese market. So Chinese currency going up is not bullish for Chinese market, but it's local currencies appreciating versus dollar. Typically, it's a positive for EM ex China. Yes, in that environment, you want to be favoring non-Chinese EM markets over Chinese markets.
If the Fed decides to cut rates in the second half, would it be an opportunity to buy EM stock?
No, I don't think so. We have been arguing that Fed hiking rate or cutting rate is not main driver of EM assets. In fact, the main driver of EM risk assets is global trade, global exports, global manufacturing. That's what drives emerging Asian market, that what drive commodity prices, which drive Latin American market. So the primary driver of emerging market equities and currencies is not Fed. It's a global manufacturing, global export cycle. So if Fed is going to cut because US is going to go into recession, that's a bad news for emerging markets. So growth is going to be more important than Fed interest rate. But if Fed is going to cut because US inflation down, but US growth is going to stay strong and global growth is going to recover, yes, that could be a reason. So again, underlying reason to buy sell emerging markets is not Fed policy. Underlying reason is global growth. And I assume that Fed will be cutting rates because US growth is very weak, close to recession, which is bad news for emerging markets for next 6 months. That's why we are still negative on emerging markets.
And in your scenario, which EM do you think is most promising in next year?
I think our outlook for now is for next 6 months, because 6 months later, global geopolitics, global macro environment might change. But for now, overweight in relative terms is not in absolute terms. Within emerging market equity portfolio, investors have to be invested. Our favorite markets are Korea, Vietnam, Thailand, Mexico, Chile, and Peru, and Poland. Those are markets that we're overweighting within emerging market equity universe. Again, this is relative to benchmark. This is for relative outperformance, not for absolute returns. I believe the US market will be going down too over the next 6 months. And if US market goes down, US dollar goes up, it will be very hard for any emerging market, stock market to go up. So in the environment of global risk off and dollar going up, which is my view, and if that view is correct, it's very hard to be bullish on emerging market, any country in absolute terms.
What indicators should the investors monitor to determine the best timing for entering the EM?
As I said, the best indicator variable that works with EM for more than 25 years, it's a global trade, global exports, global manufacturing cycle, because it drives emerging Asian economies and also drives commodity prices, which are basically another part of emerging market benchmark, like Latin America, South Africa, and so on. Again, it's a global trade cycle that matters for emerging markets.
The Korean market has been generally flat for the past 2 years. What is your outlook for the Korean stock market?
As I said, it will be very hard for any market to go up if there is a global risk off and emerging markets going down. Korean market will go down in US dollar terms. That's how we look in markets. However, as also I mentioned, Korea is among our overweight. And the reason why we overweight Korea, even though we're negative on global trade, on the global exports, it's because tech stocks in Korea. Tech stocks in Korea, we think they will do well in relative terms. They're producing high-end semiconductors, high-end memory chips, and demand for high-end memory chips is going to be pretty stable and strong. So even though global trade goes down, so that's a reason why on a relative basis, we favor Korean market.
The last question. The Korean regulators promote a value-up program by benchmark Japanese. The program encourages listed companies to increase dividend and improve their governance. However, unlike Japan, there are no mandatory factors. Do you think this program will work?
It's very hard to say from bottom-up level whether this program will work because we are not doing bottom-up company analysis. But I think just to say that it's a corporate governance problem in Korea, that's why Korean stock market has been flat for a very long time, is not correct. I think fundamental reason why Korean stock market in US dollar terms has been flat for very, very long time in a trading range. So corporate profits in Korea in the past 20, 25 years have been flat, the same level. They go up and down, but they're still the same level they were 10 years ago, 15 years ago, 20 years ago. And investors don't like flat profits with zero growth with a lot of volatility. So Korean market is cyclical. Why? Because Korean companies are very export-oriented. They sell global business cycle. It's very volatile. And Korean corporate earnings have been quite volatile with basically no much growth, structural growth. And investors don't like flat profit with a lot of cyclicality. Investors pay high PE ratio for markets that can deliver strong growth with low cyclicality. That's why US market has done well. So what's my message? The key problem in Korea is corporate profits is not kind of regulatory stuff. If regulatory stuff is there, is good. But if corporate profits in Korea don't change, market will not go up on sustainable structural basis.
That's good. I think same way. Thank you so much for your insight and time. We see you have continued success.
Thank you very much. Thank you for the invitation.